All right, let's get right into it. The UK government is in a really tight spot. It's on this urgent hunt for something like £20 billion before a massive budget deadline. And honestly, everyone is asking the exact same question: where is that money going to come from? And this quote from the former Bank of England governor, Lord Mervyn King, it just perfectly frames the whole dilemma. How do you plug a massive hole in the budget without just slapping new taxes on property and assets that could, completely backfire on the economy? That's the tightrope the Chancellor is walking right now. To put it another way, the government is basically searching for the equivalent of £20 billion down the back of the nation's sofa. And it really looks like property and other assets are firmly in its sights. This isn't just business as usual, it's a response to some really serious economic pressure. Yeah, we're calling this the UK's budget black hole for a reason. This whole scramble for cash is being driven by a pretty serious downgrade in the country's productivity, mixed with all the economic headwinds blowing in from around the globe. Simply put, doing nothing just isn't an option. But hang on. Before we get into what the government might do, we need to understand the economic landscape it's operating in. So let's take a quick look at the UK economy's vital signs right here, right now. Now, what's really fascinating about this is the story it tells of a market that's split in two. I mean, look at this. We're seeing rent growth in the Northeast at almost 9%. That's more than double the rate in London. It just goes to show you there's this huge shift in demand towards more affordable parts of the country, and that's keeping prices and activity buzzing up there. And this slide? It brilliantly illustrates the current mood. The number of new properties hitting the market is slowing down, just barely ahead of last year. But then you look at sales agreed. They're actually up nearly 4%. So the key takeaway here is, while there's a bit of hesitation, the underlying desire to buy and sell is actually stronger than it was 12 months ago. So what does this number mean, 13.2%? Well, that's the average share of property listings that have had their price cut in 2025. Now, that might not sound like a huge number, but it's 23% higher than the 5-year average. It shows us that sellers are having to be a lot more realistic to get those bargain-hunting buyers interested. Okay, this is a really important one to wrap your head around: fiscal drag. The government has frozen income tax thresholds. So what does that mean? It means as your wages hopefully go up with inflation, more and more people are silently pulled into higher tax brackets. It's like a penalty kick for the Treasury, a stealth tax that raises billions without them ever having to announce a single rate hike. So this brings us to the main event, the Chancellor's chessboard. What are the high-stakes moves being considered to find that £20 billion? The first big question, the one creating a ton of uncertainty, especially at the pricier end of the market, is this: are we about to see some kind of mansion tax? Well, the analysis suggests the probability is high. We're talking around 80%. But it might not be as straightforward as a tax on all high-value homes. The speculation is that it could be cleverly disguised as a tax on homes that fall into council tax band F and above. Politically, that lets them frame it as a wealth tax, even if it's really hitting a specific group of homeowners. The next area where everyone is holding their breath is capital gains tax, or CGT. And this is a major concern for anyone who owns assets, like a second home or stocks and shares. Now, while a massive hike to income tax levels is seen as pretty unlikely, it could actually end up reducing the total tax collected. A different, but still significant change is on the table. They could remove the death uplift, which right now basically erases any capital gains tax you owe when you die. And this potential shift is causing real anxiety. One survey found that a whopping 85% of landlords looking to sell are doing so mainly because they're worried about capital gains tax. So what other levers could the Chancellor pull? Well, there's stamp duty, and the focus here would likely be on property investors and international buyers. So will they be asked to pay more? It seems very possible. The government could take a multi-pronged approach on this one. First, by jacking up the rates on additional properties. Second, by adding another 1 or 2% to the surcharge that overseas buyers already pay. And third, a pretty significant hike on the non-residential surcharge, which could go from 2% all the way up to 6%. And here's one that could be a real game changer for landlords. There's serious talk of applying national insurance to rental income for the very first time. This is a biggie. It would hit landlords' profits directly, and the chances of it happening are basically a coin toss, somewhere between 50 and 60%. So these aren't just abstract policies floating around in Westminster. Let's connect the dots and explore the ripple effect. What could all of this actually mean for your wallet? This slide lays it out pretty clearly. If you're a homeowner in one of those higher band properties, you could be facing a new tax. For landlords, it's a potential triple whammy of national insurance, CGT changes, and higher stamp duty. And what about renters? Well, looking at past tax changes, it's very likely landlords will try to pass these costs on, which could mean, you guessed it, higher rents. Even savers aren't totally safe with that fiscal drag we talked about and potential cuts to ISA limits.
So, what happens next? The Chancellor is facing an incredibly difficult balancing act here. They need to raise a huge amount of money without derailing business investment or just crushing consumer confidence.
This quote really captures the feeling on the ground. Instead of one single massive tax hike, the strategy is probably going to feel more like a death by 1,000 cuts. A whole buffet of smaller, stealthier, and more widespread tax changes that all add up.
Which leaves us with the final, crucial £20 billion question. Will this combination of fiscal drag, targeted property taxes, and all these stealth charges be the necessary medicine to stabilize the nation's finances? Or will it be the very thing that stifles confidence and chokes off a fragile economic recovery before it even gets a chance to start? We are all about to find out.